Last week, we talked about 3 tricks to avoid dividend cuts. If you haven't seen that video, you have to go back on the channel. The number 1 trick was to trust the market. I know it's kind of crazy, but when a company offers a high yield, it raises a red flag. Not all high yield are dangerous, and this is what we're going to cover today. So today's a part 1 of a 2-part series where I'm going to cover 4 high yield Canadian companies, and next video next week will be 4 US stocks with a 4% or more yield that is still going to be safe, and not only safe because they're going to maintain it, because when a company maintains its dividend, you suffer from a passive dividend cut. So it's not a safe dividend. It's actually a dividend that is being cut by inflation every single year. Down the road, in the next 5-10 years, then your dividend is getting cut by 25, 30, 35%. So you don't want that in your portfolio. You want a company that at least managed to increase its distribution by 2-3% every single year to maintain your buying power. Dividend Growth Investors, bonjour, my name is Mike Yahoo, and I'm the founder of Dividend Stocks Rock, and also all this YouTube channel to help you invest with more conviction so you can enjoy your retirement. So today it's all about those income-seeking investors looking for a safe haven to invest. So the first one on my list is Telus. I just covered a bit of it in the losers that some investors didn't know what to do with that. I do have it in my portfolio. It's actually part of my top 10 largest holdings. I'm keeping it. I've been a shareholder of Telus for probably more than 10 years actually, so I'm not really losing money right now, but still, obviously, since mid-22, it's not a party in my portfolio, right? The thing is, Telus has been massively investing, so it means that they grew up their debt level every single year for the past at least 5 years, right? So the debt interest to be paid on that will become a burden. However, I really like where they're going with that. So Telus business is pretty much about the wireless industry. So they are very, very strong with wireless clients. They have a good renewal rate. They increase their number of clients, and it generates predictable cash flow. On top of that, instead of doing a classic play like Bell and Rogers, what they do is that instead of going towards media, they go over artificial intelligence and technology. So eventually what I see for the future of Telus, and it's going to be a wireless and technology stock. So they have Telus International working on artificial intelligence, and they also have Telus Agriculture and Telus Healthcare using softwares to help healthcare specialists like drugstores to manage their inventory. They also help farmers to manage their crop and their land. So they use their technology and all the investment that they've made in the past to help other industries. I really like those growth vectors. Obviously, it comes with some kind of a risk as well, but in the meantime, the company is able to increase its dividend every single year. Actually, it offers 2 dividend increase per year. So on top of having a yield above 5% right now, which seems like quite a deal if you look at the average of the past 5 years, the dividend has just been increased by roughly 3% not too long ago, and it's likely going to be increased by another 3% going down the road, because usually Telus increases dividend by 6 to 7% per year. So it looks very interesting at the moment, and definitely a company that increases its dividend twice a year for several years now. It's far from being close to cut it down. So I have plenty of confidence on this one. I keep it in my portfolio. Obviously, this is not a buy or sell recommendation. Please do your due diligence and make sure that Telus is a good fit for your portfolio, but it is definitely a good fit for mine. Moving on to one of my favorite stock actually, and it happens to pay a yield slightly above 4%, and it's National Bank. I could have talked about any other of the big 5, but I decided to tell you more about National Bank. Why? Because it's the smallest one, and it's often overlooked because of that. Because obviously in terms of size, it is no way close to the big guys such as Royal Bank and TD. However, it is faster and more agile because it is smaller. And as you can see on the dividend triangle, revenue and earnings are still in good shape. Obviously, right now, I can expect that the next quarters, and it's the same thing for all the banks, you're going to see an increase of provision for credit losses. So therefore, earnings are expected to decline a little bit, but the dividend is strong and is a temporary problem, as I can say. In the meantime, the business is still doing well. National Bank has been outperforming all the other banks over the past 3, 5, 10, and I think 15 years. So they are the ultimate bank play in Canada, in my opinion. What makes them so interesting is their wide diversification. So they have roughly 50% of their business that is coming from classic banking activities. So personal loans, mortgages, commercial loans, deposits, but the other 50% is coming from money market, capital markets, wealth management, and there's a lot of money to be made in wealth management as well, and also across in the US and Cambodia. So they decided to make those acquisition with like they're replicating their business model they have in Quebec in Cambodia, meaning that they are a super regional bank over there. So they're the number one bank in a small country, so they know a little bit how it works. It has great success so far, and they also acquire Credigy in the US, which is a credit specialty agency that is also doing well. So going forward, I think they have a lot of growth vectors due to their diversification, and they are well placed both in Canada and both outside to continue to generate this kind of returns. Again, similar to banks, I could have talked about all the other banks. I could talk about Brookfield Infrastructure or Brookfield Renewable that also pays a yield above 4%. But among the Brookfield family, if you're looking for yield, I would probably go for Brookfield Asset Management. Why? Because it's an asset-light business. It just got spun off in December, pays a yield of 4%. The management in place has a crazy expertise. They've been very successful for a lot of years, over 25 years of success here, and they invest in what we call they use patient capital. So they invest in renewable power, infrastructure, private equity, real estate, and specialty credit. The way they work is they don't invest their own capital. They just gather funds from retail investors and mostly institutional investors, such as like large pension plans. So this is a sticky business, generates predictable cash flow. So it's easy for them to just take that money, invest it, charge a fee on the assets under management, and be done with it. They are well known in their expertise. Not many asset manager goes into those alternative assets, so that makes them even more interesting as pension plans try to diversify their portfolio and not only get stock to the stock market returns, but rather having those large assets as all the infrastructure that they are able to generate cash flow year over year, but they are spread through the next 25, 50 years going forward. So they're a bit less liquid, but they generate a lot of value. So this is why I think Brookfield Asset Management will continue to increase their dividend, and in the meantime, you can enjoy a 4% yield, which is quite generous considering the type of business they are and the growth potential they offer. Last but not the least, you know I'm not a big fan of the energy sector, but I wanted to go across several sectors. So instead of like focusing on a specific one, I wanted to offer you a few different options to dig in. So the last one is Canadian Natural Resources, CNQ. This one is sitting on large assets of oil and gas that they can generate at a very cheap price. So as long as the oil barrel is above 35 bucks, they're making profit, which is pretty cool, right? And they will adjust their production depending on the market. So whenever the market goes up and the oil barrel price goes above 100 bucks, they generate a bunch of it because they want to get paid, and then when it reduced, they just reduce production and they go accordingly. So they are able to manage to increase their dividend for more than the past 20 years, which is quite rare for this type of company. If you compare it to Suncor, which has a similar business model, well, Suncor cut their dividend in 2020 during the pandemic crisis, while what CNQ did, they actually increased it. So they show the very strong business model they have. Obviously, the stock price will not going to continue to go up forever. This is the type of stocks that whenever the oil market goes down into a down cycle, which we see slow down right now, the stock price will remain stagnant for maybe several years, but you will enjoy a steady dividend that will continue to increase, and you still get more than 4%. It is quite safe. It has been proven in the past. CNQ went through multiple oil bust, recession, crisis, name it, and still were able to increase their dividend. If you want more stocks like this, more stock ideas, I suggest that you download my Rockstar list. This Rockstar list shows only stocks that shows revenue growth, earnings growth, and dividend growth over the past 5 years. You can add an additional filter in the Excel spreadsheet to put 4% yield and up, and then you'll get only the best stocks that pays a high yield, but they're still growing in the past 5 years. So that could be a great start to start digging and look into not too many stocks to build your portfolio and generate a great returns. So again, the download is in the link description below, and give me a thumbs up, follow the channel. It helps me a lot to share the wealth and spread the love of dividend growth investing across this YouTube channel. And next week, I'm doing the same review, but on the US side, bringing you 4 US companies with a yield above 4%. All right, stay tuned and don't forget to stay invested.